Presidential Wealth Management. We live in changing times, and when it comes to investments, it pays to learn all we can about those changes and the companies that are positioned to benefit from them. What will the new normal be? What will change? What won't change? How will we know when we get there? Will there ever even be a new normal? Or is change the new normal? If it is, then it pays to remember that all investments are made on two basic questions. What will the future bring, and what investments will benefit from it? That's our focus in this Eagle's Nest webcast. And which investments will benefit from it, and what will the future bring? Here to help us with that is Dave O'Rourke, president of Sofos Investments. Throughout Dave's career, Dave has worked with companies that managed billions of dollars. He's brought a number of innovations into the financial services marketplace. Dave, our thanks to you in advance. And I want to start out with something that we're going to go to in greater detail as it moves into the future in just a few minutes. But if you would summarize a trend that we all know about, but we know very little detail about it. And some of the details are quite interesting when we're talking about major trends. Summarize, if you will, your description of the trend that moved us from horse-drawn transportation to automobiles.
Well, it's a pretty interesting subject, and thank you for having me on, Keith and Taylor. I really appreciate it. People don't realize in 1900, 90% of all power created was created by humans and animals. 90%. Now, today, that number is virtually reversed. Now, only about 10% of power is to zero. People may not realize that it took a long time for the horse to be replaced by the automobile or by the internal combustion engine generally. You may not realize that much of the warfighting advantage that the United States had in World War II against Germany was because we could crank out so many automobiles and so many trucks and so many half tracks and so many personnel movers, and the Germans could not compete. When they moved at the pace of a horse-drawn wagon. Wow. In World War II. It took 50 years fully for the horse to be replaced on the American farm from the delivery of the very first tractor. So we think things are different now. We think there's more at work now. There's a confluence of things. This isn't simply the invention of the internal combustion engine and its ability, to put wheels on it and then move things around and people around. There's a lot more going on now. But what's happening now, if you think of it in terms of the accelerated pace of change, is really every bit as profound as the move from human and animal power to machine power. Now we believe it will go from machine power to computational power.
More with Dave O'Rourke, president of Sofos Investments, on the Eagle's Nest webcast coming right up. From Presidential Wealth Management, I'm Keith Weinman with Taylor Leary.
Fantastic, Keith. And Dave, it's going to be a fun conversation today. Looking forward to getting your insights on some of the trends, the macro trends in today's market, as well as how you guys are positioning yourselves at Sofos to take advantage of some of these trends. So we're excited to dig into that. For our audience, we're really excited that you're here with us today. This is a live event, so you're seeing this live and in the flesh, although it's over some of those new technologies that we're going to be talking about. And so with that being said, I want you to take advantage of this opportunity in the best way and really kind of utilize the system in the best way that's the best way possible. And so I'm going to walk through a couple of things to allow you to engage with us at a deeper level. So first off, we have a chat feature. This chat feature is going to be a great way to ask your questions. There are a lot of questions that we have as it relates to investments and what's going to happen next. And unfortunately, we don't have the crystal ball, but this is a great way to get our insights because this is something that we work on every single day. So use the chat feature. Now, if you're one of those that might be sitting, being a little bit hesitant to ask those chats or ask those questions, know that this is a private chat feature. So it's not going to be shown to the broader audience. So it'll actually just go to the three of us. And what we'll do is we'll take that question and we'll try to fit it in as best as we possibly can. And at the very least, try to hit it before today's or the end of today's event is through. If you are watching this afterwards, you can always send us an email at webcast@presidentialwm.com. It's another great way to get in touch with us. Now, throughout this call, there are going to be clients, there are going to be people that are not working with us yet that will have a lot of questions as to how does Sofos, how does your investments fit into your overall picture? I'll point you to the offers tab. The offers tab is a great way for you to connect with us. So I'm going to publish that right now. And it is a way for you to schedule a one-on-one call with one of our advisors if you don't currently work with us. If you do work with us already, you might reach out to your advisor directly if you have questions specifically on Sofos. But for those that want to just connect and schedule a call with us, use the offers tab to select schedule a meeting now. It's a free one-on-one consultation to figure out what the next best step is for you. So that's the best way to do it. And I will point to the chat feature throughout just as a reminder. So we're excited to have a full room today. Dave, let's kind of start with the foundation and really start to understand kind of the landscape and maybe the shifting landscape. You talked about the horse and buggy going to the vehicle, and now we're talking about electric vehicles and hyperloops and this and that. What are some of the short-term trends that we're seeing in our investment landscape and kind of our technology landscape?
Well, it's funny because I believe that the definition of short-term is changing from what it used to be. Everything, all the changes that I'm interested in and that I prepared myself for today, I suspect will happen in the next 10 years and maybe significantly sooner. And these are big deals. So as I say, it's thank God for the steam engine, which led to the internal combustion engine and which led to real revolution in human productivity beyond belief. On the other hand, what's happening now is happening at an exponential pace. That was a linear set of changes. They made sense in the context of what people were trying to accomplish. It's interesting. In the short term, we have right now a revolution in AI, in artificial intelligence. Right now, we have a revolution in robotics, in 3D printing, in visual reality, in augmented reality, in synthetic bio. A lot of people never heard the phrase synthetic bio. It's a big deal. In blockchain, a lot of people aren't really familiar with what blockchain is, but it fundamentally changes the way that minds are shared. All these things are happening in the same moment. So what does short term even mean any moment? There's a phrase in future think called deceptive. It's a phase of change. And it means that ideas that seemed crazy yesterday seem fantastic today. I mean, ideas that were just making no sense. I mean, you can look back and say the movie RoboCop. RoboCop is now. RoboCop is today. Looking person, a 6-foot-tall machine that walks and acts like a human being because back in a lab, there's a human being doing the walking and responding in real time to the activity. So think about what this means for security. Think about what it means for health events. Think what it means for like an Ebola breakout somewhere in the world where you don't have to send a doctor in. The doctor can be safe in the rear with the gear. The robot goes in, solves the problem, can't get sick, can't be hurt. You can shoot it unless you shoot it in the right place, can't be harmed. These are the things that are now. So what is short term and what is long term? It's difficult to even think long term because of the profound demography and computational power changes that are underway today, right now.
So there's a term in technology, Moore's law, which is basically to say that the microchip every 18 to 24 months gets twice as fast and twice as small, something to that effect. And so we're able to use this computing power. Is that attributing to this technological advancement?
Well, you're referring to Gordon Moore, co-founder of Intel, made a.
Correct. Oh no, it looks like we had Dave drop off there. And what we'll do is when we have Dave run back in or jump back in, we'll just probably have him reduce or at least eliminate his video, and it'll just come through as an audio stream. Dave, are you back there?
Yeah, I am.
Okay, I think what we'll do is just have your video stay off, just from a connectivity perspective.
Tell you what, Taylor, would it be better if I turned my video off?
No,
if I'm
it has nothing to do with that, Keith. We're all good. Okay. So with that though, so Moore's law basically is saying that there's going to be, an acceleration. Now, one of the things though that I find fascinating, and this came to light recently, is in a speech that Warren Buffett did in 1999. And it was at the Sun Valley Tech investment gathering. I forget what it's called. He kind of stood up and had his moment to bash some of the new tech guys. That was the later stages of the tech bubble. And basically in that speech, he said that when the automobile was introduced, there was something like, I think, 3,000 auto companies. And at the end of things, after everything kind of washed out, there was 3. You had the big 3 left. So in this day and age with innovation and technology, how do we access this in a way that's going to make sure that at least most of the time we're right with picking our winners?
Well, now we're at a hybrid point, if I could say that, between how do we deploy, how do we make decisions around a future-looking exercise and a sort of a thoughtful forecast about immutable, unstoppable trends, and then how do we deploy capital to that?
Okay.
At Sofos, we're not a private equity fund. We don't seek to set up a basket of startup companies and hope to separate the winners from the losers, what I call, trying to find the diamonds among the gravel. We're not doing that. We're seeking to find and invest in those 3 companies that emerged from those 300 because they had a superior advantage. And that advantage could be a network effect. Mm-hmm. It could be, look at Walmart and their remarkable logistics. They are the world champion of logistics when it comes to moving things from place to place. When it comes to the logistics of the internet, look at Amazon, a remarkable company that lost 98% of its value in the tech wreck back 20 years ago. 98% of its value disappeared. How could you have known what a stunning buy a money-losing bookseller would become? Difficult to know. So we seek companies that have persevered already and that have a leadership advantage that is so significant that rivals can't compete on margins for that business, that new entrants can be absorbed, and that substitutes can be realized in the same way Coca-Cola has Dasani sparkling water. Right, so you would think sparkling water would destroy a big piece of the soda pop industry. What it did, it made the soda pop industry bigger. If you were Coke, seek that have an unfair advantage, are consistent with and on a path with these fundamental themes and meta trends that we see having developed and are developing right in front of us right now.
I love your use of the word fundamental, because that's what we're talking about here, are fundamental things where companies have combined their embrace of technology and artificial intelligence with a proven track record and the ability to pivot into something that is beginning to form. Let's go back for a minute and we'll go to examples of companies that are doing this very thing. And that is, of course, what Sofos is. But first, a little bit more about the trends. Let's go to population and the growing middle class. Let's go to electric vehicles. Let's go then to the Internet of Everything, which, be careful when you define those words in your head, and let Dave do that for you. Let's touch on those three things, Dave.
So, Keith, that I love this topic and I love this conversation and I find it endlessly fascinating. We essentially believe that trends are broken down into two big categories. The first is technology. And technology shows up in computational abundance, for example. Before we even talk about what the Internet of Everything actually means, you have to realize that Gordon Moore was right in 1965 when there were, a handful of transistors on an integrated circuit. There were two in 1958 when Intel started its business. By 71, there were 2,300 transistors on a chip, even smaller. In 2017, there are, believe it or not, 27 billion times the computing power on one of these chips. Not only was Gordon Moore right, he gets more right every year. And from a price performance standpoint, a machine that produced 5 megabytes of memory costs $120,000, and it required a forklift to move it. Today, a $1,000, this is a true statement, a $1,000 laptop has 10 trillion times the price performance.
Good Lord.
Yeah, so you talk about, was Gordon Moore right? Gordon Moore gets more right every single day. And so technology in terms of computational abundance produces time abundance for people. It demonetizes old orders and old platforms. When you combine it with a communications abundance, the 40, 20, 30, all at 5G and supporting all 8 billion people, now you can look at demography and see how these two things are completely integrated. They can't be separated. And that's what actually the Internet of Everything is. It's when human minds are connected to the Internet of machines. And so we will see increasing genius. Why? Twice as many people will be put to work thinking with each other. That genius born in Eastern Europe in a small village who never got to talk to anyone, or who died of a kind of a curable disease before his genius could be brought into the world, that won't happen anymore. And combine that with increasing lifespan, which is a dramatic thing. And you see these, what we believe are immutable trends. The world is getting richer. In the developed world, we are living fantastically longer. We're looking at what's called, and this is really out there, but this is a big investment in the world. There's a lot of companies chasing this thing called longevity escape velocity, meaning breakthroughs in healthcare and technology, which come in a million versions, by the way. There's a lot of work being done on the human lifespan, a remarkable amount of it. And that's where we see big data and AI and machine learning having gigantic impacts. But longevity escape velocity posits the idea that every year a breakthrough will occur that adds more than 1 year to a human lifespan. And so if you can just live long enough, don't ski down that double black diamond, Keith, because if you can just hang on long enough, there's a chance you can live forever.
Well, Dave, I might throw that back in your lap. And you were telling me about a little bit of a digger you took over the handlebars on your mountain bike. So I might suggest the same dose of reality.
And that would be wise of you to, and wise of you to give, and wise of me to take.
So tell me a little bit about, like,
give you, if I could, just another thing that I sort of find fascinating about this short-term, long-term thing, if I might.
Mm-hmm.
So it's the difference between linear change and exponential change. So to highlight that, a linear example would be if you take 30 linear steps, you got a first down. You're 30 meters further than you were. But if you take 30 exponential steps, you go around the Earth 26 times. And so 65 million years ago, the dinosaurs died off in a cataclysmic environmental eruption, and then nothing happened,
So fascinating.
Business and the real advent of the internal combustion engine. But then 10 years ago, Uber wiped out the taxi business. Travelocity and Expedia killed the travel agency business. If you're still using a travel agent and it's not an online travel agent, you're definitely in a minority. Netflix destroyed Blockbuster. This is all in the last 10 years. Airbnb is a mortal threat to the motel industry. And right now, in front of our eyes, Zoom Communications is worth more than the 5 largest airlines in the world combined. It has a $47 billion market cap. It has no rolling stock. It has a tiny number of employees. These airlines employ hundreds of thousands of people, have hundreds of billions of dollars of infrastructure, computing equipment, rolling stock, and real estate. And yet they're not as valuable as an internet communications company that nobody ever heard of 12 months ago. This pace of change is real.
So let me ask you this then, and this is a intellectual, hypothetical, maybe philosophical. I don't know where it's going here, but when we look at the United States, we've been the leaders in innovation for the most part for many years. Let's just say the last 100 years or so, or even more, and really kind of leading that charge, albeit, there's some other countries that have done a nice job as well. That said, we're seeing China, as an example, emerge really, really rapidly. And one of the things that has allowed them to do that is that they've actually been able to do that quantum leap where they haven't had to go through some of the infrastructure challenges of laying fiber optics or doing some of the things that we've done and have built our infrastructure on, our capacity from data and fiber optics and things of that nature. Do you see that some of these emerging economies, because they don't have necessarily the legacy infrastructure, I'll call it, that actually might take that quantum leap? So we're seeing some of this this technology deployed pretty heavily in parts of Africa, in Asia, in Asian countries, where they actually don't have the burden of some of the stuff that we've done over the years. They're just jumping right over that and going to the brand new technology because it's a little bit more mobile. How does that play into kind of the future of innovation?
Well, it might be that steps over into some very controversial areas in market management. United States clearly is a world leader in transparency when it comes to commerce. We are clearly a leader in the idea of conflict resolution in the United States. And what we don't have farms set up to pirate the software of Israel or other really active countries in development. And it's true that if you go to Africa, you don't see a lot of communications infrastructure, but you do see over a billion people in a continent of 1.25 billion people who have a cell phone. Now, so I know it might be seeming far afield here, but I think the implications are a lot more interesting and make me more optimistic than any of that. And I'll give you an example. Over 80% of all venture capital investing happens in 4 cities in the United States: Boston, New York, LA, San Francisco. So one state does about half of all the VC investing in the United States. And this creates a brain drain on local economies, and it in a lot of ways, it doesn't make any sense. And in every way, it will be replaced by a virtual Silicon Valley. Why does a young genius have to move from Tehran or from Beijing or from Augusta, Maine to the Silicon Valley, where real estate is insanely expensive? They might not even speak the language, and they really don't get any benefit from doing it when they can sit in front of $1,000 laptop with a 5G connection and communicate with any other brain on the earth at incredible speed, and with translators that'll translate any language to any other language right now.
The universal translator. Dave, go, if you will, then take what you were just talking about to the effect of those people, that person halfway around the world who happens to be an internet genius with a cell phone, and add Starlink and 5G communication to what? Every square inch of the planet Earth almost?
It is believed by organizations like Singularity University and many other thought leaders, that every human being will be connected to in a 5G network by the year 2025, every single one. Now understand that 5G is 100 times the computational power of 4G. Now, where you're going with that, I'm afraid, and I'm afraid to even go down this road, is to the brain-computer interface, where we have seen now the implanting of these rice-sized chips into primate brains. Now, these are delivering 2 gigabytes per second performance. And so if you remember the movie The Matrix, they have a helicopter. Nobody knows how to fly it. They download the instructions, jump in the helicopter and take off, fly like a pro.
Yeah. That's
what the brain-computer interface promises, that at the moment, the information directly into your brain. We don't know what the implications for all that will be. People like Elon Musk you can listen to him for hours on YouTube talk about this. But it does strike me that whether or not we're able to make a biological link or not, soon the computers will not need us to think on their own. Yeah. I'm a person who's optimistic about that. I think that's fantastically wonderful news, because I look around myself and I see, left to their own devices, humans don't always make the best decision. But again, that's controversial, and it gets into some really, really, there's a universe in your fingernail kind of stuff.
Yeah. Quickly, I don't want to skip over the global middle class that's growing 5 times faster than the world's population. I don't want to skip over electric vehicles, just 2 of the trends that have been developed, global trends that are underway right now. Whether we choose to acknowledge them or not, they're happening. And many companies have positioned themselves to pivot and take advantage of these trends. But help me if I'm not doing these justice. Think of the power of the world global middle class growing at a rate 5 times faster than the entire population. All of those people improving their quality of life, improving their jobs, improving their earnings, improving their spending power, wanting more, consuming more, and then electrification of vehicles. It seems to me in past discussions I've learned that with you, Mr. O'Rourke, that we're not ahead with regard to that as much as we want to think we are. The world is adapting to that a lot quicker and faster than we are. And we're likely to follow along, and that's likely something that will be quite dramatic that we'll see in the not too distant future, correct?
Oh, I think so. It's this concept of what was a crazy idea yesterday is a status quo today. And so, for example, go back and look at the market cap of Ford Motor Company 10 years ago and Tesla and look at it again today. Ford Motor Company, which built the Rouge River plant 100 years ago, which has a global footprint, which is an iconic company, virtually put out of business by Tesla. They're going to continue to make the F-150 and the Ford Mustang. All other vehicles will be electric.
Wow.
So why? Why is that? Because that's where the money is. So what we have to figure out is, what do we do with all these gas stations, right? What are we going to do? I'm in the San Francisco Bay Area to Lake Tahoe this past weekend, and we took our electric car. And we have an app on the phone. And the app says, in 2.7 miles, there's a fast charger waiting for you right next to an In-N-Out burger.
Yikes.
Think about what they have to know about me, right? Just think for a minute what they have to know about me in order to send me that message. They have to know where my car is. They have to know how fast I'm going. They have to know how much energy I'm using. They have to know what my food preferences are. They have to know how much time I have. And they have to communicate with me in a way that I understand and will obey, ultimately, because I pulled over and got an animal style cheeseburger. And if you haven't had one of those, it's incredible. So I am very optimistic about all of this. But I think in terms of a business opportunity, it's going to be difficult to measure. It's definitely in the trillions, no question. Yeah. And I can't imagine a long-term world, a generational world, in which we will have more internal combustion engines and fewer electric vehicles. I simply can't imagine it.
Understood.
So let me ask you then, where does Sofos fit in all of this? And at the end of the day, what is Sofos?
Well, Sofos is an investing platform that investment advisors use to guide their clients to a successful retirement. We are not a private equity firm, even though I had some experience with private equity myself as an investor and as a businessman. There's not the business that we're in at Sofos. We're in the business of building portfolios for real people with real lives, and people who don't have the inclination or the time or the wherewithal or just even the desire to try to follow these trends and try to build portfolios that maximize them. So since we build portfolios for real people, we want to make sure our portfolios have market-like volatility. We offer a couple of different portfolio options, one of which is exactly equal to market volatility because it's a passive strategy that uses ETFs in a global footprint. But for our forward-looking, in the context of what our conversation is today, our 4 Alpha portfolio is designed to be comfortable for the investor, to have low turnover, to be very tax efficient, to be filled with names that the clients can experience every day, that they trust. And ultimately, we think that's one of the key deliverables. Our firm is based upon the idea that investor behavior has that most investors, many investors anyway, fall into a sell low, buy high trap during bear markets. This is the one thing we're setting out. We're trying to capture robust returns that are in line with this forward thinking. But we want to do that in a way that people can survive. So we want market-like volatility. We want low turnover. We want recognizable names like Starbucks, Nike, Apple. You can see them on the screen, Coke. There's a combination here of defensive stocks that we believe, or at least we know always have done well, or virtually always done well during downturns because people have to have a Coke. They got to watch TV. They're not giving up their Facebook or their Google or their Microsoft for any reason. They'll continue to take their life-saving drugs. And when times are good, they'll go on vacation and they'll shop and they'll fly. And like all those people around the world that have come into the middle class, they'll buy products from Colgate-Palmolive and Procter & Gamble. We see rosy days ahead for those retail companies like Nestle and Heineken and even Chipotle Foods. So what we've tried to do is gather a portfolio here of brands that are on these trends. And we can identify each of these trends that you mentioned and we had on the screen there, Keith, the demographic and technological trends. We can demonstrate which trends each of these names is on. And then we can identify that this name, Coca-Cola, this name, Facebook, Berkshire Hathaway, Roche, Stryker, these are the winners in their field in that trend. And as long as they remain the winner, then we've got a great opportunity to build long-term capital gains and to manage the portfolio intelligently so that we continue to have a portfolio that fits these fundamental screening criteria.
And correct me if I'm wrong, no startups. A dozen of these companies are over 100 years old, and 7 of them, am I correct, or 9, are over 70 years old. Companies that have pivoted to position themselves to take advantage of the mega trends that we're in now that are going to amplify themselves and the companies who are part of them in the future.
Well, that is the goal in constructing this portfolio. There's some terms that we use, terms of art in portfolio construction, like high conviction. That means don't own hundreds of things. It means own dozens of things. There's 35 names here. We know all of these companies well. To get to your point, these are not newborns here. But many people won't know the name Diageo there in the upper left-hand quadrant. But Diageo is by far the world's largest beverage company. It rebranded and changed its name back in 1997, I believe. But it has had a company in its in 1627 and has been in continual operation. We know that people like to take a drink. Some of these companies are older than you might think. Nike was born in 1964 and Microsoft in 1975. And it kind of get to the point that Taylor was making earlier is like, how could we know in 1997, 98, 99 who was going to win? How could we know whether it would be Yahoo or Google, and that Google would win by such an enormous margin as they did? Well, we couldn't have known, and we're not looking to pick that bionomics company right now or that next unicorn. We are looking to build a retail portfolio for real people who need to get to a secure retirement and understand that they're going to have to take equity risk to get there. So we're making a simple calculation. There will be demographic and technological changes. They will have profound effects on businesses, on those businesses' revenues and profits and operating competitiveness. And we want to pick companies that have demonstrated exactly that. So we can go back to the internet boom. And if we had bought Google, Amazon, Alibaba, Netflix, and Salesforce in 1999, we would have done really, really well. I don't know that we will continue to capture those sort of early returns, but I'm confident that those companies will continue to dominate their market niches and they'll continue to innovate. And a company like Apple, which is sitting on a huge amount of cash, or Amazon, these are enormous cash stockpiles, will be able to acquire competitors and startups and new entrants into their spaces.
Wow. Tell me, there must be something I don't know about Scott's Miracle-Gro.
People like a green lawn. And they like to garden. And the company is in, again, you look at around the world, Scott's is selling products to people who 20 years ago didn't have indoor plumbing.
Wow.
20 years ago had never, believe this or not, billions of people 20 years ago had never owned a toothbrush in their lives, never bought a bottle of shampoo, lived an entire lifetime, never had a shower. It's hard to consider how much the world has moved along in the last 20 years and how much more disposable income there is out there. And it shows up in all kinds of ways. And one of the ways is in this global gardening spike. And then that's.
Dave, if you can hear us, we've lost your audio.
We've lost your audio.
No.
Oh, there we go.
There we go.
Okay. Well, maybe that was a good thing.
No, it wasn't.
I love the garden boom.
Yeah, go back to the global gardening spike.
Oh, well, you see, people spend all kinds of time in leisure now that they didn't have before. So, like, for example, to go back to these technology trends, AI is expected to produce some stunning amount of relief for the global worker on the order of billions of hours a year of work replaced by AI. Billions of hours per year from AI. And that number is exploding. What are people going to do with their leisure time? They're going to garden. They want a green lawn. They're going to compete for flower contests and stuff. Look around here at my house, we're big consumers of Scott's and Miracle-Gro. Although, we don't let our personal, use of these things, determine what we put in our portfolio. I will tell you, I use Salesforce and Microsoft and Apple every day.
Yeah.
I wear Nikes. I drink Diet Coke. I watch TV, so I'm inundated with Netflix and Disney. I search Google hours a day. I'm a routine Amazon user. And fortunately for me, I'm in pretty good health, so I don't need a lot of those things except maybe the Band-Aids that come from J&J. But I'm a big-time drinker of Starbucks. And so, we are people too. And we know that there is a sense that people get of belongingness and affinity with certain companies. That has been an important part of building this portfolio. We want familiarity because it will increase trust. And when we do that, we can have a really, really positive impact on investor behavior.
So that actually leads me to a very interesting question, and I appreciate your going on the insight and with some of those companies, because you're exactly right. Starbucks or Chipotle's app is like so easy to use, it's kind of dangerous because of how frequent I go there. Now I want to use this slide as sort of a point of that I want to make and help me understand how maybe a Sofos could fit into a client's portfolio. So we've seen this, and you've talked about investor behavior pretty extensively, or at least alluded to it. And there are numbers that are, pretty much back this up through and through. And that is the annualized 20-year return of the S&P was 7.68%, almost 8% there. But the average equity investor was just shy of 5%. So that's a massive underperformance, relatively speaking. So how does Sofos and behavioral investing come together to create a better opportunity for investors? And how does that overcome that challenge?
Well, let me give you a fun fact here, Taylor, that hopefully people will appreciate. There was back in the day a very famous American investor who ran a thing called the Magellan Fund. His name was Peter Lynch. And he got so famous that he was on football commercials. He became very famous, and the Magellan Fund produced in excess of 14% a year for the 11 years that he was the manager on that fund. And by the way, once he left, despite naming his own successor, has never achieved anything remotely like that. During the period of time when the Magellan Fund was producing more than 14% a year, the average investor in the Magellan Fund made less than 3% a year. Wow. They would buy Magellan when it was hot, and of course it was at the top, and when it rotated and lost money, they would sell it. Then they would buy it back again at the top, and then sell it at the bottom, and do that over and over again, and destroy 80% of the value that Peter Lynch was delivering. Why? They didn't know what was in the fund. They didn't know how Peter Lynch made his decisions. They didn't know a single company. Remember, Magellan was the guy that went around the world, right? So Peter Lynch was in early on the idea of global investing. You know, he was like the first China guy, really. That was early days of the curve, and he picked up a lot of excess return. The problem was people didn't trust the experience they were having with that portfolio. We're trying to solve that problem. You know, I've been reading these. You can see the fine print on the chart that's on the screen. You see that word Dalbar there at the bottom. They're a consultancy company. They produce a comprehensive guide every year, an analysis of investor behavior. They're looking at investors in mutual funds, and they're tracking the performance, the buy, sell, high, low overall performance of these retail investors. No one in my industry disputes the numbers that the Dalbar report puts out. And year in and year out, the average American equity investor underperforms the average bond yields. So they are taking a multiple of bond risk and receiving less than bond return. We think it's a big problem. We think it's tough enough for people to make it to a secure and dignified retirement without having this problem added to it. So we believe that what needs to be injected into this whole process is much more about trust. We're not, you saw our portfolio, it's not a hedge fund. We're not doing quant mechanics. This isn't a momentum play. None of that. It's a simple idea that it's easy to see that the internet of everything is ascendant, that people are living longer lives, that they're getting richer around the world, that the amount of computational power added to the amount of communications power, the abundance of capital, and this is important, the reversal of scarcity. And that's an important trend we haven't talked much about, but there's a reversal in scarcity. Those things we believe are easy to see. And so we want to buy great companies that understand that and are well managed and have found a way to compete in a way that seems unfair against their competitors.
Absolutely magnificent. You remind me, wasn't it Warren Buffett who said, buy good companies for the right reasons and turn off the news?
Turn off the news is the best news, is the best advice that I can imagine giving to any investor. This is a long-term game.
And explain, if you will, a little bit of the structure. First, the Sofos, to my understanding, 4 Alpha is absolutely and totally liquid. And all of the stocks that you saw on that screen, all of the companies you saw on that screen are represented in the portfolio in either 5%, am I correct, or 2.5% allocations. Is that correct? And why is that?
So you broke up a little bit on me right there, but my first answer, I did hear, yes, this is a fully liquid portfolio. And it's also, we are a human company. Remember, I started this thing with the premise that we want to work with the entire person. And so if someone has an objection to owning one or more of the companies in our portfolio, they simply can exclude it. You simply don't have to own it. Now, the difference between long-term gains and short-term gains is pretty much the entire game. I mean, that's pretty much it. If you can find a way to keep all of the gains. And this is, of course, why there's an explosion in Roth investing. You get to keep all of the gains without paying tax. And there should be an explosion in Roth investing. So imagine if you don't have a Roth account and you still are trying to achieve that, you have to think strategically about how to own the investments that you own. And so for us, it's a simple thing of putting the right stocks in the right buckets. So a dividend payer should go in your IRA, a growth stock in your non-qualified account. So you have to think about those. Those are some of the values that we put into our technology here. You also have to think about the fact that there will be volatility, and you will not have a straight up ride with any stock. You can see that in Tesla just last week. Mm-hmm. And if we have opportunities to harvest losses, we'll take them. Meaning we'll sell the stock for a 31-day period of time and buy it back. And we'll use that to offset gains in other positions. So using these techniques of low turnover, asset location, and harvesting, we think we can do just about all that you can do to reduce the tax corrosion that inevitably happens, in any free society like ours.
And that's why you said earlier that volatility is important. You want the ups and downs with the market, albeit not wanting to go down as far and wanting to go up higher if you can. And then the other thing I think where I dropped out with you was the allocation of each of these stocks. It's not like it's mostly Amazon or Tesla because they're more expensive stocks. The allocations are either 2.5% or 5%. Is that correct?
That is correct. We equally weight 30 of the 35 names to 2.5% positions. And 5 of the companies we own 5% positions in. So if you just multiply these things out, you'll see they equal 100%. Now, Keith, I want to mention to you that by the end of the day, on the first day that we make these investments, those weightings will have moved around. Mm-hmm. Some stocks that day will be up and some down and some in different directions and some with different amounts. And that's good. That's fine. We believe anyway, one of the underlying premises here is you let your winners run. It's tax efficient, but it's also just smart money.
Very nice. Very nice.
So we actually got a question here on their chat, and it has everything to do with digital currency. I guess my question to you is, what would necessitate adding another company that might, maybe 2 years ago, Tesla is not on this list and they're on there now. How does a company get included into this portfolio?
Well, it's interesting. There's a new term that your chat person probably knows, but may not know. But for everyone else, there's a new term called the ICO, not the IPO. The ICO is an initial coin offering. And there were a record number of initial coin offerings in 2020, over a record in 2019, over a record in 2018. The business hasn't settled out. We don't really understand from a business standpoint. I'm talking about industrially. Don't really understand the P&L characteristics. Don't really have a set of stable fundamental valuations that we can put on those businesses. It's really tough to invest in them. And so they're not part of our portfolio, and they won't be until we have a liquid, transparent, and open marketplace for those products. And it may end up being an index type approach. That probably would be, the first way would be to own all the tech companies back in 1997 rather than try to sort out the winners ahead of time. The way it gets in is the way Upwork. You notice that Upwork was on our list. Upwork got in because there's been a big change in the way that people work. Like, I'll never go back to working, commuting into downtown San Francisco again. I will never do that. You can't make me. I don't know why I did it for so long. But we know that people have changed the way that they will work forever. And so they should. It's better for everything and everybody if we work in this more virtual way, in our opinion. So that is the newest of the companies in our portfolio, and we think it represents a big.
There's so much information out there, and I wish we could spend, another couple hours digging into it, because it felt like we just scratched the surface into this particular portfolio, into the philosophy and the fundamentals of Sofos and how they're approaching the marketplace, and maybe seeing things through a bit of a different lens here. And if you are watching and you have questions on not only how Sofos might fit into your portfolio, but how investments might fit into the portfolio, the one thing that we found or has been made abundantly clear is that oftentimes when clients come to us, they don't know the why behind their portfolio strategy. They don't really understand quite exactly why they own X, Y, Z company or XYZ fund. And it really doesn't make a lot of sense. So if you're struggling with trying to figure out what the strategy looks like, this is a time for you to connect with us. If you are already working with us, reach out to your specific advisor and figure out if Sofos is the right plan. And it may be a great opportunity to reposition yourself, especially with what has happened over the last 6 months. If you are not working with us, use the offer button and take that time to click that button, and it will schedule a time with one of our advisors, whether it's myself or with Keith or somebody else in our office, our other caring and experienced advisors. We'd love to have that conversation with you and figure out how maybe a Sofos might fit into the broader picture. So, Dave, thank you so much for your comments today, your insights, your expertise, and really for spending such a long time, kind of scratching the surface on this. And we want to have you back on.
Well, I would love to come back on. Can I take 10 seconds and just say
you have a couple minutes here just to kind of wrap things up.
I want to point out that while the future can come at you very quickly and it can disrupt your comfortable life, your status quo ante, you should be very pleased about things that will happen in the next 10 years. Things that were scarce will not be scarce anymore. Every day, the sun puts 6,000 times the amount of energy that human beings use on the earth. 6,000 times. Right now, as we sit here, there are quadrillions of gallons of fresh water in the air, not in the ocean, in the air, and we know how to extract it. More wealth will be created in the next 10 years than the last 100. And no matter how it gets distributed, we all be better off.
David, sounds like we lost you again. Can you hear us?
Yeah, sorry about that.
Okay, please go back to no matter how it gets distributed.
No matter how this wealth that will be created in the next 10 years gets distributed, there's a lot of arguing about distribution of wealth. I'm telling you that there will be enough for everyone, enough health, enough learning, enough time, enough money, enough expertise, enough resources to help every human being have a better life by 2030.
Amazing. Dave, do us a favor, turn your camera on again.
Okay. So I put my robe on in the intervening period. No, I'm just joking.
Thank you. As Taylor said, for more information, Presidential Wealth Management. If you're already in contact with somebody at Presidential Wealth Management, call that person, email that person, give that person your questions. And if you're not, talk to us. Talk to us about what you'd like to know. Talk to us about what you'd like to see on future Eagle's Nest webcasts. Just email us at webcasts@presidentialwm.com. Webcasts@presidentialwm.com. Dave O'Rourke, Sofos Investments, thank you very much. I'm Keith Weinman for Taylor Leary from Presidential Wealth Management. Presidential Wealth Management securities and investment advisory services are offered through Forta Financial Group, Inc., a registered broker-dealer. member FINRA and SIPC.